Very good afternoon to all of you. On behalf of Committee for Members in Practice of Institute of Chartered Accountant of India, I welcome you all in today's VCM on five-step model to the revenue recognition. It's a very important Ind AS, that is the revenue recognition, as well as the cryptocurrency. Both the topics are very hot these days. Revenue recognition concept, that is the related to Ind AS, as well as the cryptocurrency. And there are a lot of changes. There are a lot of discussion in the recent budget also relating to this cryptocurrency. So we are having with us two eminent speakers, two eminent personalities, our chartered accountant fraternity only, CA Komal Ahuja ji and CA Anil Kumar Gupta ji. On behalf of CMP, I welcome you, Anil sir, welcome you, Komal ma'am, and it is my, we are thankful for sparing your valuable time and acceding to our request on a very short notice to deliberate on today's VCM. So it is my proud privilege to share with all of you the brief profile of Komal ji and Anil ji. Madam Komal Ahuja ji is a chartered accountant with 10 years of experience working with big fours in financial accounting and advisory services. She has extensive experience of handling complex business transactions, including IPO advisory, etc. And she has given various VCM and webinar also for the knowledge dissemination activities relating to the Institute of Chartered Accountant of India. I welcome you, ma'am. And once again, thank you so much for spending your valuable time. Anil is a chartered accountant in 1984 batch. He has qualified 4 CA course and conducted ICI IFRS International Financial Reporting Standard. And he's a diploma in system audit. He's a central government nominee of Central Council of Institute of Company Secretaries of India. And he has remained member of various committees of Institute of Chartered Accountant, including Accounting Standard Board of India, Accounting Standard Board of Institute of Chartered Accountant of India, ASB, Auditing and Assurance Standard Board of ICI, Public Finance and Government Accounting Committee of ICI, Committee of ICI on Companies Bill for recommendation of the to the Parliament, and various study groups created by the ICI on preparation of guidance note on CSR, and study group of ICI on preparation of guidance notes of independent directors, and Committee on Internal Audit and Internal Control of NIRC of Institute of Chartered Accountant of India. He has authored very important and very good book on this practical issues of TDS. It is available in the market, and he has contributed a lot to the various government departments. He is a visiting faculty of Income Tax Department, Ministry of Finance, for the training cell at RK Puram and Civic Center, New Delhi. He is also a visiting faculty Delhi VAT Department and Punjab VAT Department. He has taken training sessions and workshop at Service Tax Department, and has also taken the training session of 62nd and 63rd batch of the IRS training. And the still list is very vast to introduce that. So from the core of my heart, Anilji, once again welcome, and thank you so much from the core of my heart for acceding to our request to spare your very precious time. Thank you, sir. And so without wasting much more time, let's move towards our first technical session relating to the revenue recognition. We are having with us CA Komal Ahuja ji. Over to you, CA Komal Ahuja ji, for the 5-step model of revenue recognition. Over to you, Komal ma'am.
Thank you so much. Thank you for such an introduction, and thank you, Anil sir, for joining. And I request you to bring in your inputs wherever necessary. So I will just share my screen and present the PPT. That's going to help. Is it visible?
Yes, ma'am. Make it full screen. Press F5.
Yeah.
Yes, it is fine, madam.
All right. So the 5-step model to recognize revenue, I think a lot of companies in India, specifically, they have already applied this standard, right? They know this standard now. India is very well equipped with this standard, but still, there's a need to, there's always a need to see that, what is it that is there in this standard? Whenever we are stuck in a transaction, we go back to the standard, look at the paragraphs, and then see that what needs to be done. It is very important because it just changes the top line. The moment you realize that there is something that is bundled and needs to be unbundled and taken to a different period, it just altogether changes your top line. Yeah. So today, I'm just going to give you a brief overview of what is this five-step model to recognize revenue. Yeah. So what is the first step? Okay. Before we go on to the step-by-step process, the core principle over here is that, everything has changed from the risk and reward approach to a control based approach. Okay. And we look at it, once we go through the standard. And the standard has very clearly, given the guidance. It was not that a lot of things have changed, but a lot of things have now been specifically written in the standard. That has made a lot of change. Okay. So where the guidance earlier was vague, or was taken from, let's say, IFRS or US GAAP, now the guidance is much more wide. Yeah. And there are very less differences, if you compare your Ind AS 115 with respect to the other gaps, which is, let's say IFRS 15 or ASC 606. So in a way, all the boards are kind of aligned when it comes to revenue recognition, unlike the standard such as leases. So what is it that this five-step model tells us? So there's they have just given a step-by-step way to reach the final destination, which is your revenue recognition, which is going to change your top line. Yeah. So what is the step one? If you today, when we are going through this session, let's kind of make our own checklist. Okay. That if today I have to implement or verify or review whether the revenue 606 or Ind AS 115 or IFRS 15 has been implemented properly or not, then one may just look at these five steps and kind of see that whether everything that is required to be done, is it satisfying the step or not. So let's say if your step one is not satisfied, then you may not even go to step two or step three. It's not even required, right? So you need to fulfill step one for you to go to step two. So let's look at the steps. The step one says identify the contract with the customer. Okay. What is a contract? Contract is basically an agreement which creates enforceable rights and obligations. So definitely it requires two or more parties, because I cannot have a contract with my own self. Yeah. Contracts can be written, contracts can be oral. Written contracts, I think most of you would have seen. But what could be an oral contract? So like for example, yesterday, so last month, my ATL executive called me up, and he said that you will have to you can change your plan from 299 to 399, and I agreed over the call. And in the subsequent month, when the bill came, I paid the bill as per the new plan. So I did not sign anything for the new plan that was communicated to me over the call, but I accepted it. Yeah. So you would find very less of oral contracts, however, practically in the industry when you work. But there could be a possibility of having oral or implied contracts, yeah, based on your customary business practices. Okay. So it says that it does not exist if both parties can cancel without penalty. To say tomorrow I can cancel the contract without paying anything to the other party, and likewise other party can also cancel the contract at any point of time without any reason, right? Without paying any penalty. Then it's just a mere paper, right? It's not even a contract, so it's not enforceable. Yeah. So you will have to see whether it is enforceable or not. Yeah. So when you're preparing your checklist now, that's the step one. Okay. Contract should be a contract with enforceable rights and obligations. Yeah. Could be written, could be oral, but mostly you will find that there are written contracts, and both parties should not be able to cancel it without paying penalty to the other party. Yeah. Now, the standard has also, gone a little deep and, kind of explained that what is a contract. Okay, while we can very easily identify, like for example, it says that the parties have approved the contract. So if it is that, I enter into a contract with you tomorrow and I do not sign it off, I don't agree of it, I don't agree it, I don't approve of it, then it's a mere paper. You cannot tomorrow tell me that I'm legally bound to act as per the contract. So when I'm committed to perform, I should approve the contract, and not even one party, but the other party should also approve these. So the parties involved in the contract should approve of it. Yeah. um, each party's rights should be identifiable in the contract, right? Payment terms should be identifiable. Contract should have commercial substance. Yeah, it should just not be that I'm selling only to inflate my revenue. It should have a commercial substance. Yeah. And there should be a probability that the entity will collect the consideration that it is entitled to. Okay, okay. So does it mean that tomorrow, if out of 1 lakh, I had to give a discount of 10,000, and I could only take out 90,000 from the customer, would it pass this criteria or not? See, basically this criteria is very critical, to kind of to kind of see, because there are two possibilities. One is that the customer is not going to pay. Yeah, there's a history that the customer is not going to pay, or the customer has gone bankrupt, or things like that. When it is like that, then the probability of collection itself is at risk, and therefore you may not be able to even recognize the revenue, and the other standards like IFRS 9 or the ECL may come into picture. But when you know that I'm going to give some discount to this customer, because of which my transaction price may not be 100, my transaction price may my net transaction price may get reduced to 90,000 instead of 1 lakh, then that you should be aware, it should be probable that you will be able to collect that 90,000 out of that customer. Okay, so that is what it tries to say when it talks about collectibility criteria. Okay, substantially has not been defined, but substantially usually is taken as a 90% benchmark. Okay, moving on, when you have identified the contract, okay, when you know that, okay, this is my contract, it's enforceable, it has been approved by the parties, the rights are identifiable, or payment terms are there, it has a commercial substance, collectibility is there, then you move on to the step number 2. Okay, which is a very, very important step. If somebody falters at this step, then all of the next steps become futile. The exercise for all of the next of the steps become futile. Why? Because your entire revenue recognition process is dependent on how many obligations do you have. Okay, so it says identify the performance obligation. So there are two-step model to identify the performance obligations in the contract. So for example, I may have taking an example, I have a car, I have bought a car, and along with the car I've been given a free service. Yeah, but if I look at the car and the free service, I need to see whether these two are two performance obligations, or are they one performance obligation. Okay, so what do you think a performance obligation can be? A performance obligation, is it a promise? It necessarily not be just a promise. Promises may not be obligatory. Okay, but all performance obligations will have promise. Okay, so to make it simpler, you need to see that, it's just not a promise. You have an obligation, okay? You have a contract where you have enforceable rights and obligations, right? So if you have an obligation to fulfill something, then it becomes, a performance obligation. So how do you identify how many performance obligations are there? There could be 1, 2, 3, 4, 5. How do you see? So the standard has given a two-step model to kind of tell you that, what is a performance obligation. Step number one, it says that, is it the good or the service, whatever you are selling or rendering, is it capable of being distinct? Okay. While if you look at this, you will find, and I'll tell you some examples about this. You will find that almost 90-95% of the things, arrangements, step one is usually passed, okay? And therefore the standard setters added a cumulative condition which said that, focus that on whether the good or service are distinct in the context of the contract, okay? So for example, I am a builder and you come to me and you want a flat, a ready flat from me. Now I involve a plumber, I involve engineering services, I involve an architect, I involve an interior designer, let's say. I involve a lot of people, right? Piping, wiring, all of this stuff. Now let's say that, this entire set of services which are different, which are distinct in their own self. Engineering is a different service, interior designing is a different service, or a piping or a wiring is a different service, right? But what does the customer want from me in the context of the contract? The customer has contracted with me for that particular flat, right? A ready flat, for that customer. It doesn't talk about that I want the plumbing services from you, or I want engineering services from you. Yeah, it doesn't talk about that. The customer wants a ready flat from you, and therefore, when you look at both of these steps together, it says it means that, it has just one performance obligation, which is the residential flat, okay, which is a ready residential flat. Whereas if you look at a car and of free maintenance services, okay, which a lot of companies provide, after every quarter or every kilometers that you run your car, you get a free service, right? So that's an optional thing, okay? You may go to the company and get it done, or you may just go to a private dealer and get that done. So but the company gives it to you for free, okay? So how many obligations are there? So if I look at the first condition, the car can function on its own on day one, even if the maintenance services are not there, right? And if I look at the step number two, the car and the maintenance services are not highly dependent on each other, okay? Within the context of the contract, the customer bought a car, right? And the customer got free services from the company, right? But I cannot say that without the maintenance the car cannot function. Yeah, I cannot say that, because my car can function from day one. I will come to the showroom, or I may even not come to the showroom for my services, right? So in this sense, they are not highly dependent on each other so as to function, right? Like unlike the residential plot, where all these services that the customer was being provided was given in the sense engineering, plumbing, and all that stuff. They were all very highly interrelated or interdependent on each other to give a combined output, which was a ready-made residential flat. I cannot say that my residential flat, for my residential flat, that the engineering services are distinct, are not dependent on giving the plot to my customer. The customer will not take the plot if the plumbing and other works are not done properly. So likewise, we need to see that within the context of the contract, what is being asked, right? And whether what is being provided, either it being a good, either it being a service, whether all those are highly interdependent or interrelated to each other, or are they going to significantly modify or customize each other so that you get the promised good or services in the contract. Okay, so step number 2 is very, very important, because if you do not know that how many obligations are there, then next to the steps are all going to be futile and incorrect, right? And it can change your top line altogether. So this is very important. So step 1, you have to look at the contract, whether there's a contract or not. If you pass that, then on the step number 2, you look at whether whatever goods or services you're providing, are they capable of being distinct in their own standalone capacity. Yes, the car is very well distinct in its standalone capacity, and so is your maintenance services. And within the context of the contract, they are not highly interdependent on each other, and therefore there are two performance obligations. One is a car, and one is a free maintenance services. While in the residential contract, all the plumbing, engineering, all those services are could be distinct in their own self, in their standalone capacity. They may be, the customer may benefit, but within the context of the contract, the customer doesn't want them separately. Yeah, the customer wants a residential flat, and therefore there's just one performance obligation, which is the ready-made residential flat. Okay, so this is the step number 2, which is there. Now there's a very, very interesting concept, which really kind of deals with your top line, which really has changed top line for a lot of companies, where they talk about who's a principal and who's an agent. Okay, uh, I may not say that this is a very new subject that has come in the standard. It was there implicitly. It was mentioned in brief, but not as explicitly as it is now. Okay, and it has changed a lot of things in terms of a lot of companies, which were recording their revenue at a gross level. Now, what is this principal versus agent? Okay, so taking a brief, taking a very, very relatable example of, let's say, Amazon. Okay, so today Amazon is selling goods and services, right? And it has given a platform to both the buyers and the sellers, right? And let's say, me being a customer, I go to Amazon, and I buy a t-shirt, right? A Puma t-shirt. And tomorrow I find that the t-shirt is not okay. Okay, there's some fault in the product. Okay, so Amazon might not be the party who would really make good the loss, right? Amazon is just helping you to give a platform to the vendor and the customer, and in between it's getting its own commission, for providing that platform, for providing those services. Okay, now if there's anything that happens in the obligation, which is, let's say, the sale of goods, which in this case is the t-shirt, then who is going to have the primary responsibility for fulfilling that promise? It's going to be Puma. Okay, tomorrow if there's anything happens, I can go to the court, and sue the other party, right? But not Amazon, right? Who has the inventory risk is the second question. So, for example, if Amazon had, if I ordered today something, yeah, that I want a Puma T-shirt, I ordered this on the Amazon, and Amazon then passes this order to the particular vendor, then that means it's a just-in inventory, right? Just-in-time inventory, which means that the moment the customer has ordered, simultaneously the company has given the passed on the order to the main vendor, which means that Amazon doesn't hold any inventory risk, right? Tomorrow, I'll just hand over the goods, as is to the customer, right? But let's say if Amazon had got the stock, some of the stock for the best sellers, okay, and it had kept it with it, then it would be a consideration to evaluate whether Amazon is really working as a principal or just acting as an agent, because tomorrow if the goods catch fire, in the Amazon factory or in the Amazon warehouse, let's say, then who is going to take the charge of it? Yeah. So that's the second condition, where you kind of evaluate that who has the inventory risk. So the entity who's having the inventory risk is more likely to be the principal in the arrangement. So these arrangements can kind of change your entire top line, right? Uh, from the MMTs of the world to anyone like that. You would have seen that people who were recognizing about 5,000 crores of revenue have come down to kind of kind of 100 200 crores of revenue just because of a net accounting. So this is going to entirely change your top line, and this is a very very important consideration, right? So, and the last consideration, last indicator is that entity has a discretion in establishing prices. So, what does that mean? It means that who is really actually selling that product at a particular price? Who has the latitude in establishing the pricing of the product? Is it really Puma who's telling that this T-shirt is going to be sold at 2,000, or is it Amazon who decides the price, right? So Amazon may give its own discount, right? Which is from its own commission, right? But ultimately, the price of the product is being decided by the main vendor, the main manufacturer, right? So when you see these kind of contracts, evaluate who's got the control before it has been passed to the customer. So if you believe that Amazon has taken the control of the goods of the Puma t-shirts before the Puma t-shirts are being sold to the customer, then probably Amazon is acting as the principal and not Puma. Yeah. So so these three things that we just talked about, that who has the primary responsibility for fulfilling the promise, who has the inventory risk, and who is setting the prices of the goods, all these three are just the indicators. Okay, these are not this is not an exhaustive list. These are just the indicators which are going to take you in a direction, which will tell you or guide you that who's the principal in the arrangement. Okay, so just be careful while you evaluate, who's principal and who's an agent in an arrangement. Moving on to the third step. Third step talks about determination of the price. What does that mean? It means, like we talked about, a 1 lakh worth of goods being sold at 90,000. Why? Because I gave a discount of 10,000. Yeah. So it's very important to see that are there any discounts, any other rewards, cash rewards, cash discounts, any other sales based, target based discount, volume based discounts that are being given to the customer, right? If that is the case, then you kind of take that out and show the net amount as your in your top line, right? So how do I estimate today? For example, if it is a kind of thing that there are only two options to it, it's a binary kind of a discount. So what do I mean by that? That 80% chances that I'm going to give this discount, 20% chances I'm not going to give this discount. So either I'm going to give the discount or I'm not going to give this discount. So there are only two options, right? So it's a binary kind of a thing. When there are only two options, we go by the most likely option, because we need to estimate on day one when we're recognizing the revenue. We also have to estimate the discounts that are going to be given. So let's say if we today did not know that what is the discount amount, then we estimate. Okay. And how do we estimate? If the outcomes are just two, either I'm going to give the discount or I'm not going to give the discount, then I go by the most likely method, which means what is the most likely outcome? So if I'm saying that 80% I'm going to give the discount, then I reduce the discount today, and then I kind of show the net profit, net revenue in my P&L. While let's say there are a couple of targets. For example, if I'm going to sell 0 to 10,000 of units, and I'm going to give 10% discount. If the sale goes up to 20,000, then I'm going to give 20% discount. If the sale goes up to 30,000, then I'm going to give 25% discount, and so on and so forth. So then it becomes, there are there's a range of possible outcomes. Today I do not know where will I fall at the end of the year, but today I also want to start recognizing my revenue. So what do I do? How do I estimate? How do I estimate that what is the amount of discount that I have to net off from my revenue and then recognize the revenue? So in that case, when there are number of discrete outcomes and probabilities, we go by a probability weighted amount. Okay, that what is the weighted amount, a probable weighted amount of discount that I'm going to give to the customer. Okay, and if I move on, if you look at this example, where there are, when you see here, it clearly shows that how many possible outcomes are there. So it says that the entity enters into a contract and will receive a performance bonus up to INR 1 lakh if it meets specified performance targets. So today I do not know that what is the likelihood of achieving the targets, and therefore I can just put in some probabilities around it and see what could be the final amount. And when you have your probabilities right there, and your probabilities, your outcomes and your probabilities for those outcomes, you calculate the probable outcome amount. Okay, that I'm going to give 1 lakh performance bonus, the probability is 10%. Okay, I'm going to give 80,000, the probability is 30%. So all these data, the management can evaluate basis their trend, basis what is currently happening, what is the scenario, and all of that stuff, and then come to an amount, which is a weighted average, weighted amount, which gives you the discount amount, and that is the expected value, which you can use when you have multiple possible outcomes. Yeah. So when there are only two options, we go by binary method, which is the most likely method, where whatever is the most likely option, you decide that and you go by that. When there are more than one, you assign probabilities to all the possible outcomes, and then you calculate what is the probable amount that is going to be there, and then you take the the sum of that, and that is how you calculate the expected value. Yeah. So now let's say there are more than one obligation. Okay, there are more than one obligation in the sense that let's say taking the example of the car and the free maintenance. Right now, we said that there is one obligation which is sale of car, and there is another obligation which is sale of services, right? Free services. Now we have two obligations, and we have contracted for one price. Let's say 10 lakhs. I've contracted with the customer for rupees 10 lakhs. Now, how do I know that out of this 10 lakhs, what is the amount that needs to be allocated to performance obligation 1, which is the sale of car, and performance obligation 2, which is the rendering of the services, which is the free services, right? So the standard says that when you have more than one obligation, then you need to allocate your contractual price into all of these obligations. Okay. Why it is important? It is important because it may be possible that for one of the obligation you are recognizing revenue right away, while for the other obligation you are waiting and you're deferring that revenue over a period of time, and that may just entirely change your top line. Yeah. So when we'll come to the step number 5, we will understand that how can it change the entire set of things for my P&L. So let's right now assume that there are more than one obligation. So it's not a residential plot case. Okay, when there was a residential plot, you will not have to allocate anything. If I've sold the property, if I've sold a flat for 1 crore INR, 1 crore, I don't need to allocate anything to it. That's the only amount, and that's the only goods, right? In that sense. And therefore, 1 lakh is the amount that I'm going to recognize. How I'm going to recognize is step number 5, but there's no requirement of allocation, right? Um, while in case of a car and a free service, I'm going to allocate this price, let's say 10 lakhs, into both of these. Now, how do I do that is important. So the very first thing the standard says is that you determine the standalone selling price. Okay, if you would have sold it separately, what would have been their standalone selling prices? If you have that, uh, great, you take that as your prices and allocate in that ratio. If you do not have that, okay, if you have contracted for 10 lakhs and you don't know what is the standalone selling price of the free services, let's say in this example, then they say that you first look at the observable price. Do you have an observable price for the free maintenance? If yes, you use that observable price. Okay, if you do not know what is the observable price, what could be the price for this free services, then you estimate it. When you don't know about it, then you estimate it. How do you estimate? You first look at adjusted market assessment approach. What does that mean? It means that you look at the similar kind of market, okay, and you kind of adjust a price as per your criteria. Okay, so let's say there's a market where there are free services being sold to the customers. You can take that price as a benchmark, adjust it to your criteria of how you are selling it, what kind of adjustments you need to do in terms of bringing it in line with your particular segment, and then you can use that as a price. Okay, let's say if you believe that, oh, we have a unique service and we cannot use any other market segment as such, then you may use expected cost plus margin. So every manufacturer, OEM, who's providing these free services would know that what is the cost that's going to be incurred while I'm going to provide these free services. So you take that cost and you add some margin onto it. Okay, and that margin management will have to decide that what is the margin that I'm actually, because there's nothing free in the world. So if you're providing a service, then there's going to be a cost along with some margin that I'm going to be earning on that, right? So you add that cost and margin and you get that value. So that's how you can allocate. And the last is the residual approach. Let's say if from 10 lakhs, you know that about 9 lakhs is the value of my car, then the residual value of 1 lakh is the value of your free maintenance services. Okay, so is it that I can just switch over to residual approach? No, you first look at the standalone selling price, you look at the observable price. If not, then you go to your estimation. Okay, and you look at these various possibilities of estimation, yeah, and reach to a price that's required to be allocated. So let's say now you have, out of 10 lakhs, 9 lakh is for my car and 1 lakh is for the free maintenance services. So you're good to go for your final step, which is your how do you recognize the revenue. Now this is a very important step, because the standard says that you first need to see that. So there could be two possibilities. Okay, either you recognize revenue, let's say your contractual period was for 2 years, so either you recognize your revenue over the period of the contract, which is 2 years. Okay, how we can see, but over the period you can do that, or at a point in time, which means out of this 2 years span, at what point of time do you believe that the control has got transferred? Okay, and the performance obligations have got satisfied. That is the point, out of the 2 years where you can recognize your revenue. It could be at the beginning, it could be at the end of the contractual period. It could be anywhere, but there are criteria given which will give you a direction as to when do you recognize your revenue. So by default, standard says you need to first check, the three criteria for over the period revenue recognition. Okay, if you're falling for any of the three criteria of over the period revenue recognition, then you will have to recognize your revenue over the period. If none of the criteria for over the period gets satisfied, which we will go through, then you need to find out the point in time where you will recognize the revenue. Okay, so what are these over the period revenue recognition criteria? Let's look at it one by one. It says the entity's performance creates or enhances an asset that the customer controls as it is created or enhanced. Okay, so let's look at this way, that you have some softwares, right? And you have called upon the software service provider to upgrade your systems, right? You cannot take your systems to the software provider, and therefore you have called the engineers from there, and it's happening at your place, in your company, right? So whatever enhancements or upgrades that are happening in your system, as and when those upgrades are happening, you are controlling that because it's happening in your system, right? It cannot be taken away. So that's what it means, that as the entity's performance creates or enhances the assets that the customer controls as it is created or enhanced. So if I am taking those upgradation services, I am kind of controlling the enhancements that are happening on my system, right? So if this is the case, then in a way I will have to recognize my revenue over the period. Now, how do I recognize? There are there are two kind of ways, which is formally two kind of ways: input method or output method. Where I can probably look at, I can go to the place, do the survey, understand how much work has been done, and record my revenue. I may also look at that I have contracted for 1,000 hours, billing hours, man hours, and out of that 100 man hours have been used, and therefore I will go by 100 by 1,000 percentage of completion kind of a thing, and I will recognize to that extent. So these are the various kind of things that you can look at. How much of the milestone has been achieved, how many man hours have been already used. Okay, how many kilometers have been run, how many units have been produced. So all these are the methods that can be used to recognize your revenue. But you will have to see that which method depicts the most correct way of passing on the control, as well as fulfillment of the performance obligations. Okay, so it's not that it's at your will. It's not a free choice. You will have to look at a consistent and a consistent method which can depict the revenue recognition in the right way. Okay, so if the first criteria, which is of the transfer of control, is as and when I'm performing, the customer is receiving the benefit, so like an upgrade to a system. Yeah, if that's the case, that means that you can start recognizing your revenue over the period, right? Next is that the customer is receiving and consuming the benefits of the entity's performance as the entity performs, which means, let's say if I'm a logistic company and I have to ship the goods from location A to location C, and when I reach at location B, which is somewhere in between A and C, let's say my truck gets there's a default, there's some defect in my truck, and I'm not able to take those goods from B to C, right, for the remaining kilometers. Now, as a customer, I have already received some services, which are some kilometers have been run by that truck or that shipper, right? Now, I would not want that my goods should come back to location A, and from location A I will again, go to location C. I would rather, go from location B to C. So I'll find someone in location B who can ship my goods for the remaining kilometers. And therefore, this means that, I will not have, if I today take, a new supplier, okay, that new supplier will not have to re-perform the service that has already been performed. Okay, so whatever kilometers have been driven by the previous supplier, the new supplier doesn't have to re-perform that. Yeah, it can move on with from location B to location C. Yeah, and therefore this is also one of the criteria for over the period of revenue recognition. You will also find it very a lot of this in the service industry. Let's say where like we took an example of logistics, because so the companies like these, practically they kind of look at how many kilometers have been run, and then they kind of recognize revenue over the number of kilometers run, by divided by the total number of kilometers that are required to be completed. So in this case you just need to see whether the customer is simultaneously receiving the benefit or not. Okay, so if, let's say, I'm the auditor of a company, and today I started my audit procedures, and tomorrow I felt that there's some fraud in this company, and I disclaim it. I said I'm not going to do the audit, and some other audit company comes into picture, and they take the audit. They will have to re-perform the entire audit. They will not rely on my audit procedures, and therefore whatever audit procedures I had done till date, the customer was actually not receiving the benefit out of it. Okay, uh, because my ultimate product, which was signing off the balance sheet, was not yet done. And therefore, in such cases you cannot say that that the other party will not re-perform and will use my audit methodology, whatever I had done, as a basis. No, they will definitely do their own independent procedures to kind of sign off the balance sheet, right? So there's a difference in various sectors, in terms of various sectors. Uh, could be a service industry, but still, you may satisfy this criteria for some, you may not satisfy the criteria for some of the industries. So you will have to be careful while evaluating this. Okay, and the last criteria is the entity's performance does not create an asset with alternative use, and the entity has a right to payment for performance completed to date. So let's take an example that, I'm a component supplier, and I supply steering wheels to the manufacturers. Okay, and I have entered into a contract with, let's say, BMW, and now BMW is kind of an amber, and they have suddenly terminated the contract, and now I have to now see whether I can do anything else with this set of steering wheels. Can I sell this to Audi? Can I sell this to Maruti? I cannot, right? So what do I do in such case? It means that I have created an asset which does not have an alternative use. Okay, which is very, very specific to the customer, and my agreement, I should have a right to payment for my WIP. Okay, whatever, let's talk about the cutoff date. As if, let's say, if I'm at 31st of March, if I'm standing at 31st of March, uh, I should definitely have a right to payment for whatever cost I have incurred till date, with some reasonable margin. Okay, that margin could be different from the product margin. Let's say my product margin was 10%, but this margin could be just 3%. That's fine, but I should get my payment for whatever work I have completed till date. Okay, so this is the third criteria, where whatever I'm producing is a very unique asset which cannot be given to any other customer, provided I spend a lot of money to customize it again, all over again, and then sell it. So which is economically not beneficial for me. So basically, whatever I'm performing is an asset which does not have an alternative use. Okay, if it's a BMW steering, it has to go to BMW, and I have a right to payment for performance completed to date. So the standard says if you fulfill any of these three criteria, you are eligible to recognize the revenue over the period. But let's say if you do not do that, if you are not able to fulfill any of these three conditions, then you look at what point of time my control got transferred. And the standard has also given some indicators regarding that. For example, it says that you see that when does the entity gets the present right to payment, okay, for that goods and services. Okay, when does the customer gets the legal title of the asset. Okay, let's say there's an excisable invoice, and through that you get the legal title of that. When do you get the physical possession of that particular asset? When the risk and rewards of the ownership of the assets get transferred, and whether the entity has the evidence of the customer's acceptance of the asset. Okay, just be very careful on this fifth criteria, because it should not be mere formality that the customer has accepted it, because sometimes the contracts are written in a way that they are more protective in nature, and therefore they want to just kind of add on to this clause that that the customer, once the customer accepts the goods, they will give you that's when the control gets transferred. But you will have to look at substance over form. Okay, if today if I'm a car manufacturer, and I've sold a lot of 1,000 cars to my dealer, the dealer would not start every car and check, and then give an acceptance. Okay, so it should not be a mere formality. It should be genuinely an evidence of acceptance. Yeah, so these are not again an exhaustive, this is not an exhaustive list. These are indicators, and all of this will give you a direction towards a point in time where you will feel that the control has got transferred. Okay, so the very first thing that you need to do is you need to see if any of these three criteria are getting fulfilled. If any of these three criteria are not getting fulfilled, only then you move on to this at a point in time kind of a thing. And the last point that I want to take is on the contract costs, which is new in a way. But what is it that, okay, so what is it? So incremental cost of obtaining a contract. So for example, what is it that let's say that I have a sales team, okay, and I have told them that if you get this particular customer, okay, if you get this particular contract for our company, then I'm going to give you a bonus, or an amount which is INR 1 lakh, for example. Okay, and I know that tomorrow if we get that contract, I'm gonna get that back, that bonus, I'm gonna get that bonus back from the customer. Yeah, so this particular cost has been incurred only to obtain that contract. Okay, let's say one of the salesmen gets that contract from me, so I'm going to pay that to him, right? I'm going to pay this contract cost to him. But let's say if there's a CTC, there's a CTC, and I've given that, I'm gonna, to everyone, whoever joins my company, I'm gonna give this percentage of bonus, variable bonus to them, which is dependent on the business of the company. That's not going to be the incremental cost of obtaining a contract, because it's not associated with a particular contract. It's there for all. Yeah. So when it's there for all, it's not for a particular contract. Now, let's say, that salesman got a contract from me, and I have to give him the bonus, while I have not yet obtained the revenue pertaining, the corresponding revenue towards it. Then what do? I just capitalize that cost, right? And it gets amortized in my P&L as and when the related revenue comes into my P&L. Okay, so it's just like a prepaid kind of a thing, which then you capitalize and you recognize as per your matching concepts, that when the revenue comes in, that is the time when you recognize the corresponding cost. Similarly, if you look at what is the cost of fulfilling a contract, which is the last topic, for the session today. Cost of fulfilling this contract means, for example, that I'm a car manufacturer, and my dealer says that can you deliver this car from your factory to my premises. And I, having links with all the transporters, I say that yes, why not? And I have transferred the control of the goods as soon as the car gets out of my factory, right? So the moment the control of the goods have been transferred, I recognize the revenue pertaining to the goods, okay, to the sale of goods. However, I still have an obligation towards the shipment, which is I have to get the goods transferred from my factory location to the premises of the customer. Now, this particular cost, now let's say today I involve a transporter and I say that, okay, you need to get this delivered to the customer. He would take an advance from me, okay? I pay that advance to him. However, let's say the revenue pertaining to this shipment, to this freight, comes to me later on, okay? Then what will I do today when I have already paid something in advance? I will again capitalize it, okay? I will capitalize this prepayment, in my balance sheet as a cost of fulfilling the contract, right? And as and when my revenue will come over the period, because it's a service, right? And as we looked at the three conditions of services, it's gonna fulfill in this one, right? The criteria for receiving the benefits as and when the entity performs. So the moment my revenue starts coming in, I will start amortizing my cost accordingly. So that's all from my end. If there's any question, I'm happy to take. But that's on some of the key topics for revenue recognition. Thank you. Anil sir, you want to add something to it?
No, it's okay. Very nice deliberation, I must say that you
Thank
have
you.
done very good preparation.
Oh, thank you, sir.
Let's do one thing. We can start chatting because there is no other one. So, see, I have one issue with regard to that.
Yeah.
Because topic was with respect to the, I think, bottom line and top line. Is it right?
The topic was related to the top line. Yeah.
Yes. So, what do you think? How we can use this Ind AS? One is the measurement and the recognition and disclosure part. That I think the Ind AS covers very well. But there are other practical issues also with respect to the top line, which one needs to take care of. I'm just asking you. See, it's not a question as such.
Yes, absolutely, sir, and that's great that we are deliberating on this. I think from my practical experience, what I saw is that we went to a client which is in the automotive sector, and the moment we kind of told them that your top line is going to get divided into sale of goods and rendering of services, which is the shipment service, and the sale of goods. They were okay with deferring the revenue. They were okay with everything else. But the one question that that came to their mind is, what about GST? If the moment I say that I'm gonna render the service, it's gonna track GST to me, and that's where they in fact consulted the GST team, and got that resolved. So what I'm trying to say is that just having those performance obligations in place may not just suffice. It may just come up with a lot of different problems altogether, which one may not think from an accounting point of view, but could be from a taxation point of view. And that's yeah.
Yes, please.
Yeah, so I think that's one way of looking at it. And when you look at the entire transaction, it's not just impacting accounting; it's also impacting your taxation. So it's also impacting the way you recognize the way your systems have been built. Because a large of ERPs today have been built on if I look at the erstwhile standard, which was kind of based on risk and rewards. Was very, very different, and now it involves a lot of judgment as to whether it is going to be over the period, what time, how much. I'm not able to able to currently recognize the revenue. I'm going to defer it. All those questions and the presentation, disclosures, all of that is going to change a lot of thing in the I think in the IT system also, as well, in the of the companies.
Right. So do you think that this medium and small companies, though it is not applicable as such the India's, but will they be able to cope up with this the technical requirements of India's?
Why not? I think so. What I felt after reading this standard, and also while I went to my clients and had this experience of implementing this particular standard, I felt that there is nothing big which has changed, but there's a lot of guidance that has been explicitly now given, and which can just change your top line, definitely. But it is not that it was not there earlier. It was there, but it was implicitly there. It was not explicitly written that okay, this is principal, this is agent, okay, this is, but the concept, the principles, the underlying principles were there. And I believe that if you have to really recognize the revenue in terms of substance over form, then it should be easier. It should not be a challenge as such.
Good. See, I was going to ask you, because there is nothing technical which I want to discuss with you, because you have covered very well. You
you, sir.
used the term easier. So people are wary about that. The government is stressing much on the ease of doing business. So people feel that it may lead to the complexities and difficulties in implementing it.
Not at all.
Not at all.
I think it's a wonderful step towards recognizing in a way which can in fact make their financials more comparable, in fact, to other industries.
And that's true. That is there because that's the use of the Indians, there's no doubt. Because even geographically, also globally, we become comparable.
Yes, that's very important. Tomorrow, if the mid-sized companies which today are going for IPOs like anything, if they tomorrow have to go, the kind of time and effort that they're going to involve, that's going to get involved would be lesser than what they are currently doing.
I would like to place my appreciation on record that people have studied it and they are having the theoretical knowledge, but you have put it very well in the practical manner. So
thank you so much, sir. Thank you. Really,
my congrats to you.
Having it from you is a big thing, sir.
No, it's okay. My congrats to you. And
thank you,
I think let's hand over the mic to Mr. Anil Dalal.
I look forward to your session, sir.
I'm so thankful to you. And if you will be there, because
yes.
You see, it's a very upcoming topic. It's a very new topic.
Yeah.
So whatever your inputs are, will there be, we can discuss later on also. I will take your mobile from Mr. Dalal and we can discuss later on also.
Sure, sir. Sure. Definitely.
Thank you, Kamal. Thanks a lot.
Thank you. Thank you, sir. Thank you so much.
Mr. Anil Dalal ji. आप म्यूट हैं.
Can you hear me, sir?
Now you're on mute.
No. Sir, thank you so much, madam. There are two questions for you, madam. I have left, madam.
Sorry. Yes. I'm there.
Yes. There are two questions for you, ma'am. One question is if goods dispatched from our factory location and stolen or burned, what will be the impact in revenue in our books?
Goods have been
dispatched from our factory location and stolen or burned. What will be the impact in revenue or in our books?
Yeah. So I think that's what I was trying to say, that, there's this concept of shipment service, which has come where if you believe that the control of the goods have got transferred, let's say the moment the goods have got out of the factory, right? The customer says that I am taking the control of the goods. However, you need to provide me transportation services. Okay. So the standard says that here there are two obligations. One is the sale of goods. Another is the sale of the rendering of this shipment services. Okay. Now, when you look at the shipment services, you can either act as a principal or act as an agent. Okay. If you believe, you have already transferred the, if you believe that, who's the primary responsible, so for you to be a principal, you should have the inventory risk. Okay, so you may look at the insurance certificates. You can look at who's the beneficiary if the goods are tomorrow burnt, or like you said, are stolen or whatever. Who's the beneficiary of the insurance, right? That's how you can look at the risk, who's handling that risk. Yeah, like in our case, we looked at these things, these parameters, that who's the primary beneficiary from the insurance, who's having the responsibility of getting those goods to that particular place. And if once this is established, that you are acting as a principal or an agent in this particular shipment service, not for the sale of goods, but in the shipment service, who's having this kind of benefit, then you can decide that your revenue is going to be what's going to happen to your revenue. You may just recognize the freight as a net freight, as freight income minus your freight expense, which is the net freight income if you're acting as an agent, or you may just gross it up if you're acting as a principal.
Madam, how to consider the cashback or coupons in revenue recognition?
So again, I think cashbacks are again, variable consideration. You will have to estimate it at the time of revenue recognition. If you know the price, that's great. If you don't know the price, then you'll have to estimate it as per the estimation criteria that I just explained.
Under e-commerce model, if Puma, it is a general case. Under e-commerce model, if Puma in this case will transfer the point of time of sale and method of payment at the discretion of Amazon, will the Amazon constitute principal?
So can you repeat it again?
Question is, under e-commerce model, if Puma in the case will transfer the point of time of sale, means they are talking about the cashback and coupons, etc. And they are saying, if in the case of Puma will transfer the point of time of sales and method of payment at the discretion of Amazon, will the Amazon constitute principal?
So there are 3 indicators. Okay, and even before the 3 indicators, the very important indicator is the control. So if the goods are controlled by Amazon before they are sold to the customer, it is Amazon who is the principal. Okay, control is the main criteria, and then they have given the 3 indicators, which are who's having the primary responsibility, who's the prime obliger, and who's having the inventory risk, who's having the latitude in establishing the price. Now the thing that you are saying is that, let's say if Amazon has the latitude in establishing the price, that's just one of the criteria out of the 4 things that we have discussed, which is 1, who's controlling the goods before the goods have been given to the customer. If that's Puma, then even if Amazon is establishing the price, which sounds contrary, but let's say if that's the case hypothetically, then also you will not say that Amazon is the principal, right? You need to see who's controlling the goods before they are sent to the customer. Who's having the inventory risk is one of the very important criteria, while you determine control, and also who's the primary obliger, in the entire transaction. Latitude in establishing price is, and I'll not say it's not an important indicator, but if you read US GAAP and other authoritative literatures, you will find out that primary obligation and inventory risk are 2 important factors which give you, the direction towards who's having the control. So even if, to answer this question, even if the latitude in establishing the price is with Amazon, and not with Puma, you will also have to consider the control aspect, the inventory risk aspect, and who's the prime obliger. The answers of in most of the cases, the answer to all of this should go to one direction. If it's going to different directions, you will have to look at control, inventory risk, and prime obliger. I hope that answers.
Fine. Thank you so much, ma'am. These were the questions relating to your revenue recognition, and you have justified with your presentation as well as your deliberation. And as rightly said, it was really appreciable. It is not only the theoretical, but with the thorough knowledge and with the full of practical knowledge. And it is really very wonderful deliberation, ma'am. Thank you so much on behalf of CMP of ICI for sharing your valuable time. Thank you so much, Komal. Thank you so much.
Thank you so much.
Thank you. Over to Anilji. Let's move towards our next second technical session relating to the demystifying cryptocurrency, a very hot topic in these days, and lots of discussions are going on everywhere. So let's have the full of knowledge, the full of expertise, this deliberation on demystifying cryptocurrency. So over to Anil Gupta, sir.
Let me just share it.
Ji, sir, kindly.
So, okay, is it fine?
Yes, sir. Yes, sir. Full screen kar le, sir, F5.
Okay, sure. Okay.
Full screen हुआ नहीं, sir.
Mr. Dalal, is
Sir,
it okay?
full screen नहीं हुआ full screen.
हो गया, I think.
हमारे यहाँ नहीं आ रहा सर, फिर वही वाला उसी वाला इशू हो रहा है ये.
Okay.
एक बार थोड़ा आगे चलाएंगे सर. नेक्स्ट स्लाइड. क्योंकि स्लाइड शो नहीं आ रहा.
स्लाइड शो नहीं आ रहा है. Okay, but it should be there.
The same problem which I will be discussing in the morning.
But it is visible otherwise.
It is visible. In the left hand side, all the slides are coming. That's why I'm asking, can you shift to the second slide?
You mean to say only the small portion of the slide is coming?
Yes, small portion of the slide is coming. Left hand side, all these slides are coming. And
hold on. Let me try again. Just a minute. Okay, I think I'm not able to do it. So I'm starting it, right?
Fine, sir, fine.
Okay, fine. First of all, I am so thankful to Institute of Chartered Accountants of India, and especially the Chairman CMP of ICI, Mr. Sanjeev Singhal, and the Vice Chairman, Mr. C.A. Prasanna Kumar. I'm also thankful to Mr. Anil Dalal for all the support during the last 3-4 days. And my special regard to Madam Komal Ahuja for the nice deliberation. My good afternoon to all the participants. See, we are the students of knowledge, and only day before it was Basant Panchami. So I begin my deliberation with paying my respect to Ma Saraswati. Blockchain and crypto. See, very interestingly, the science of Bitcoins, blockchain, and cryptocurrencies are really very fascinating because there are so many elements to understand. But before we start with the Bitcoin as such, we need to understand certain terms and certain factors. Very interestingly, I am starting with the rider because you see it encompasses various disciplines of our subjects, including economics, law, computer science, finance, civil society, history, geopolitics, and much more. And secondly, the technology is changing very fast. So we enter into we rather get sucked into the rabbit holes. So what I feel is I will be covering today the non-technical part of it. I will try to take you to the various terms which are there with respect to the cryptocurrencies and Bitcoins. But before I reach the slide of cryptocurrency, few slides I will like to discuss to start with. Digital world. What exactly is the digital world in the case of financial transaction? Digital world is the availability and the use of digital tools See, whatever we communicate on the internet, whether digital devices, various payments, all these are the part of a digital world. A very common term is there nowadays in the social media and in the newspapers, that is digital asset. So digital asset is anything that exists in a digital forms and comes with the right to use. Then it's an asset. It's like any other physical asset. There also you are having right to use. Another discussion has started, especially with this budget, where they have announced the digital currency. So the CBDC, this term also we need to know a little bit. The central bank digital currency. At the moment, we are having physical fiat currency. So this digital currency, how will it take shape? How will we be able to store it? That part still remains to be unfolded by the RBI. But that will this digital currency will be a legal tender, and it will exactly work like a fiat currency. Now, when we begin the journey of the cryptocurrency, there are few terms which we need to understand. One is what is database and what that has to do with the cryptocurrency. Then we have the concept of technology of blockchain. Then cryptography is there. Crypto wallets are there. So let's unfold it. Let's first discuss what a database is. Database is the source where we save the data, which we are doing for last at least 20 to 25 years. Traditional databases are normal files, normal folders, which we save in the hard disk, and we use a database management system at the backend. Like Google Drive, Dropbox, all these are basically databases. So traditional database operates on the mechanism of CRUD. We use this term many a times: create, read, update, and delete. That's how the traditional database and the items saved on it works. There was a lot of power or control in the hands of one person. That's why the traditional database is called centralized database, where the power is with the user itself. Now, this traditional database is one type of database. Other is the new database, and that database is called blockchain. So blockchain is also a database where you can save. How it works, that we will unfold in the coming slides. Now, what is blockchain? Blockchain acts as an electronic ledger where you can store the various kind of data. So number of blocks are involved, and those blocks are connected, and hundreds of computers are used to put all the blocks into one chain. That's why it's called a decentralization. In our cases, where we use the traditional database, it's on our PC or on our laptop, or maybe on some separable hard disk. But here it is on various computers involved in this plethora of blockchains. So that's why it's called a decentralization. In blockchain, each computer is known as node, since each participant maintains a copy of its own records. It will just unfold after 2-3 slides more. But to understand what blockchain is, we need to understand this new database system. So blockchain technology will immediately identify and correct any unreliable information. Because there are users, there are those who have those who are the part of those blockchains, they are the users. So if they come to know about any unreliable information, then we need to have a consensus model. Consensus model means all will give the consent whether this this particular information which is trying to come into this database, whether that should be allowed or not. This decision doesn't depend on a single person, as is the case of centralization. Here it depends on the number of the users who are there in this chain. That's why there is a concept of consensus model. The consensus of all the participants on a blockchain is required to authenticate the transaction or data logged onto a blockchain. See, there are 3 types of webs. Before I proceed ahead, Web 1 was the initial computer which was static, not dynamic. So say I am taking you back to 90 or 95. At that time, it was Web 1 technology of the computers. And what we are using today, it is called the Web 2 technology. It is today's network, internet, and its immense uses, which we see in our daily life. Web 3 is the blockchain technology. So we are in the transition stage from Web 2 to Web 3. The growth of blockchain and cryptocurrency is somewhat similar to that of internet or Web 1. See, as Web 1 and Web 2 evolved over so many years, so this Web 3 will also take years, but not that many years, because now the technology has improved a lot. It has faced various type of weathers over the previous 20, 30 years. So this Web 3 we will be able to shift to Web 3 very fast. But yes, few years will definitely be needed. Cryptocurrency will form the foundational layer of this new type of internet called Web 3, and its applicants and use will increase with that time. Just like how very few people understood email and internet in the initial days, similarly, the cryptocurrency is also in the nascent stage. It will take some time. So does that mean that all the blockchain databases are open databases? So here we need to appreciate two concepts. One is the open database and other is the closed database. So let's understand what are those. In blockchain, the data is stored across multiple computers, as I said earlier, which is why it is also known as distributed ledger technology, DLT, because you are using ledgers which are lying in various computers. We will come to the hardware part of it also in the later stage, but multiple computers are used, and this is called DLT, distributed ledger technology. Now there are two types of blockchain databases. I am not discussing the traditional database. I am discussing the blockchain database, which is the second type of database. So there are two types of blockchain database. One is private blockchain and other is public blockchain. Let me first sail you through the private blockchain. See, governments are using private blockchain technology. Why? The reason being, let me take you just to take you to two examples: the land records and the health records. They are generally messed up with the government departments. You visualize some government department. You visualize some where the registration of the sale deeds take place. So you visualize those records. So government is facing a lot of heat with respect to the maintenance of these two type of records. So the governments are looking to utilize blockchain DLT for record keeping. Why? Let me take you to the why of it. Why government is interested in this private blockchain concept. See, the beauty of private blockchain is it's based on password and ID feature. That's the first part of it. Secondly, that's why it is stated that private BC is just like a traditional database. In your traditional database, you are again having a user. They can enter and the passwords can be allowed or not allowed, depends on the administrator. So, and secondly, in the case of private blockchains, the centralized regulatory authorities are there. These 2 points are missing in public blockchains. In public blockchains, you don't need ID. Those who are the part of that chain of computers where the data is being saved. So private blockchain networks restrict the access to the blockchain record only to certain participants. Each and every person is not allowed, only those who are having access by way of password and ID. Let me just give you a very simple example of it where this technology is being used. See, Telangana government, they are managing their land records on the blockchain technology. Now, those land records are not available to each and every person. Why? Why is it so? Because the government is the regulatory authority over there. They are taking care of whom to allow the access, and to whomsoever they are allowing the access, they give ID and password to them. So that's the beauty of this private blockchain is. And see, over the years, coming years, 1 or 2 years, many state governments will shift their databases to blockchain, and that will save them time, and it will be more secured, and it will be decentralized, but the power will be with the one person only, also whosoever is considered as a regulatory authority with respect to a particular type of data which is being saved, depending on which ministry is there. So that's the use of the open or closed or private blockchain. Now let's come to the open or public blockchain. The public blockchain networks are open to the public. Here, public doesn't mean that you and me. Here, public means those who are the members of that chain. So any person who is member of that chain, he doesn't need any user ID or password. In case of private blockchain, there was necessity of a regulator. Here, in case of public blockchain, there is no necessity of a regulator. There is no necessity of a ID. There is no necessity of a password. Whosoever are part of that chain, they can access to the public blockchain. And that's where the concept of Bitcoin came, which will be seen in the next 2 slides. So let me read the last paragraph of it. The records of a public blockchain network are accessible to all the participants. So these participants are the members of the blockchain. So Bitcoin is the largest public blockchain network, right? But this is not cryptocurrency. Now, what's the difference between blockchain, Bitcoin? What is blockchain cryptocurrency? Which Bitcoin cryptocurrency we hear about? Let's unfold it. First of all, before proceeding ahead, let's see what is a cryptocurrency. So you need to understand 2 terms. Token. So what is a token? Token can be fungible, token can be non-fungible. Fungible token is where each one token being more or less replaceable by another. So when a token can be exchanged with another token, if I am having a token A, you are having token B, you give your token to me and I give your token to my token to you, depending on the value, then this is called fungible token. Non-fungible tokens are where they cannot be exchanged. Each token represents something unique. So there is difference between NFT and FT. So what we are discussing today is FT part of it, and these FT are called cryptocurrencies. So what are the types of cryptocurrencies? Let's have a look at it, and which are the type of cryptocurrencies prevailing in the world today. I am just giving you a few examples. Filecoin. See, cryptocurrencies are not merely exchangeable coins as we exchange shares. Let me take you through it. This Filecoin, it's a crypto-based software which can be used to release your computer space if it's idle. It's a very good concept that has emerged over the last 3-4 years. Suppose you are having a computer at your home. It's a big, with some big data storage capacity, and it's like idle. And if you want to give it on lease, then this Filecoin software can be used for giving your idle space on lease. And payment will be made for using this Filecoin with the help of cryptocurrency. And with respect to this Filecoin, the cryptocurrency of this Filecoin or the token of this Filecoin is Filecoin itself. So here in case of Filecoin, the name of the blockchain and name of the token is same. Now let me take you to Ethereum. The main purpose of the Ethereum is to enable smart contracts. What are smart contracts? These are the contracts which are automated through codes. And Ethereum provides the technology of software to execute the contract. And Ether is the cryptocurrency to make payment to use it. Now, this is a better example than Filecoin, because in the case of Filecoin, the names were coinciding. Here are 2 terms we are using. One is Ethereum and other is Ether. So Ethereum is the blockchain. It's a software where the automated contracts will be executed. So those who want to use the contracts in the automated manner, and they find the feature of the Ethereum better, they will use this Ethereum, the Ethereum blockchain for smart contracts. And to make the payment to use this Ethereum, you will have to use the Ether, which is the coin and the cryptocurrency for using Ethereum. The third example, this is very common nowadays, Axie Infinity. It's used in the gaming industry and is built on blockchain. So Axie Infinity is again a software and a blockchain. It's not cryptocurrency. But for using this Axie Infinity, you need a cryptocurrency, and the name of that cryptocurrency or token for using this Axie Infinity is Sweet Love Potion, SLP. And very frankly, this Axie Infinity, which is being used in the gaming industry, it is based on play to earn. See, you play to enjoy or you play to earn. It depends how you take it, how you use it. So that is basic main difference between the blockchain and the cryptocurrency, the token of it. DeFi, the decentralized finance, is a big sector in the cryptocurrency ecosystem. Ecosystem means where there are blockchains, where there are private and public key, where there are wallets, where there are the coins or the tokens. This whole is called ecosystem. So decentralized finance is a big sector in the cryptocurrency ecosystem. It allows providing financial services to the people without the involvement of financial intermediaries. See, the basic aim of the blockchain technology is to remove the intermediaries. So DeFi is the right example to understand it. So many cryptocurrencies are used to build and offer DeFi services, where the financial services are reach you without there being any intermediaries. Non-fungible tokens are digital assets which are hosted on the Ethereum blockchain network. So NFT, if you want to purchase, you have to visit the Ethereum, and you need to make the payment in the Ether NFT to purchase these NFTs. So similarly, there are 100 type of cryptocurrencies, but the most popular one is the Bitcoin. So let's start the journey with Bitcoin. What is Bitcoin? Bitcoin is a decentralized digital currency without there being any central bank, no RBI, no bank of the world, but it's a currency. How? We will see it later on. Or no single administrator. And this can be sent from user to user on the peer-to-peer Bitcoin network without the need for intermediaries. I will give you some example also. Let me first take you to the theory part of it. But the question arises, why will he agree to act as a record keeper? You see, as I said, there will be multiple computers involved in this chain. And all those computers are connected to each other. So the question arises, the person who is sitting there, why will he maintain record on behalf of some other person? Why will he invest his time? Why will he put his own efforts to it? The answer is that person will get crypto token in exchange of his service, and that will be his remuneration. That's why people want to be part of this chain, to earn these cryptos, which are carrying a huge value in the market. So even in the decimals, the tokens are being sold. So that's why people are interested in being a part of this chain, but it's not easy. The hardware is very costly and technical. I will come to it. The first ever cryptocurrency was invented, was Bitcoin, and supposed to be built by a pseudonymous person named Satoshi Nakamoto. He used the blockchain technology to build Bitcoin. However, Bitcoin is only one of the thousands of cryptocurrencies, as I explained earlier. Here, I would like to stop for 30 seconds. This Satoshi Nakamoto is a very interesting case to understand. See, as such, till date, no one has ever met him. As such, till date, no one ever knows him, where he lives, who he is. There are various persons in the Newsweek. I'm forgetting the year in which it was. In the Newsweek, this topic was very well covered. This story of Satoshi Nakamoto, and the correspondent, he gave the name of some Californian who was living in California. So when the people reach his house, he was some different person and know this Satoshi. So now the technical experts have emerged to a consensus that Satoshi Nakamoto, he released a white paper on the cryptocurrency Bitcoin. But later on, various such type of people got together in one platform, which became a forum. So that forum is carrying this blockchain technology and cryptocurrency ahead. So as such, till date, no one knows who this Satoshi Nakamoto is. I stopped here just to give you a few introduction about this gentleman Satoshi. So let me give you a very interesting case study. This is a very interesting one. This will explain us what the blockchain is, what the coin is. Let me read it for you, then I will try to explain it also. Bitcoin with capital B, right? We must understand in this particular case study that there is lowercase and there is uppercase. So Bitcoin with capital B is the blockchain technology. So whenever you will find in the technical papers on the social media or in the internet that there is a capital B, then it's a technology. And Bitcoin with small b describes the unit of cryptocurrency or coin or token. This is fungible token we were discussing about. Just to explain these two concepts, I have formed a line, a sentence. I bought 5 Bitcoins. Here B is small. And saw those transactions on the Bitcoin chain. Here the B is capital. So that's the difference between the blockchain and the tokens. Was crypto primarily invented for secondary transactions? Very interesting question. What was the purpose of this cryptocurrencies? Now I am not discussing the block technology part of it. Now I am discussing the crypto coin or the crypto token, which is tradable. Public believe that crypto is an asset which is meant to be traded or is means of currency. But frankly speaking, this is not just one application of a crypto. Few I explained you earlier also. Let me take you few years back to some other products to understand the trading of this crypto. Example 1, when oil was discovered, what was the reason for it? It was used as source of energy. But over the year, what happened? But over the period, oil got so much value due to demand and supply because there was a dearth of supply. So demand increased and then it became a valuable commodity and which got started trading in secondary market. And today the inflation that we are seeing in India, it's an imported inflation. Imported means because we have to import the costly oil, so that it impacts our inflation. That's why I call it imported inflation. And this oil was not discovered for the purpose of trading. Another a simpler example is the Reliance. See, Reliance never floated the shares to trade, but the demand of shares was so much that it created market for it. And you can see the prices of various shares skyrocketing in the NSE and BSE. So the similar analogy applies to the cryptos also and their pricing also. There the supply is, there is dearth of supply and demand is huge. So the prices are skyrocketing. So each cryptocurrency can serve different purposes and its value is decided by the market, which I just explained. Most people tend to equate cryptocurrency with Bitcoin. Why is it so? Why people consider Bitcoin as a synonym of the crypto? Because it was the first cryptocurrency and it became very popular. So that's why people feel that Bitcoin is the only cryptocurrency, though it is not so. I will give you some more examples. Now, very frankly speaking, I should have started this deliberation with cryptography. But had I started with cryptography, then it would have been very difficult to understand this art of mathematics. So after understanding a bit of blockchain, tokens, and cryptocurrency, let me sail you through the cryptography. What exactly is cryptography? Before moving ahead, we will have to understand a few concepts from a branch of mathematics, which is called cryptography, right? Cryptography is, among other things, about sending secret message that can be read only by the intended recipient, not by each and every one. See, WhatsApp is a very simple example to understand it. Type the matter in English. The person who receives, receives the matter in English, but at the back, this is the front end of it. at the back end. That's why it's you, whenever you open a WhatsApp, on the top of it is mentioned encryption to encryption, right? So this encryption is basically meant for the user itself. If I as A is sending a message on WhatsApp to B, then only B will be able to receive it, and only B, and if B give it to someone else, then he can read it. So that's why I said it's a simpler example of encryption, but encryption is being taken care of by the WhatsApp on the back end. When the transition is taking place of this data from A to B, no one can decipher in between, and no one can make out what data is being sent. So that's what the cryptography is. There is a misbelief about the cryptography because you see the secret messages and it's meant only for recipients. So there is a confusion that it's meant only for spies, criminals, or terrorists, but it's not so. Let me give a very simple example to make it understand that it's not merely meant for these black portions of our society. Rather than in this world of internet, it is being extensively used to protect the data that travel across the internet. You see, whenever you see this term HTTPS, everywhere in the internet, whenever you will open, you will find HTTPS. So S in this is secured. And this security takes place on the mathematics and the science of cryptography. So your data is secured because of this cryptography. That's the anonymous strength of this cryptography. So there are some important terms which are there in the cryptography: encryption and decryption, public key and the private key, various hashes, digital signatures. Some of the terms we are well acquainted with, like digital signatures, public key and private key. In our when we do this DSA and CISA course or this FAFD certificate course, there we read about this public and private key, then symmetric and asymmetric keys. So if the time will permit, we will come to it because it's a little technical part of cryptography. So we need not deliberate much on it. Let's deliberate on the cryptocurrency itself. Now this is very important term, crypto wallet. What is it? People say that Bitcoin is stored in wallets. Here also I see, I don't know whether these slides are very properly visible to you or not, because Anil Dalalji was saying that it's not visible. In this case, the Bitcoin, we have used the small b, because here we are discussing the saving of the crypto token which are tradable and exchangeable. So people say that these Bitcoins are stored and saved in the wallets. Is it right or not? Let's take a glimpse at it. If this were true, then a very interesting situation will emerge. If this were true, then if you copied your wallet, you would own double the numbers of the Bitcoins, because it's very easy to copy a wallet to another wallet. So it's not so. You couldn't have digital money that works this way. Then the life will become very easier. Keep on copying and keep on minting. So digital monies cannot be saved like this. So no Bitcoins are not stored in wallets. Then where are they stored? And what's the use of wallets? We'll come to it. Ownership of Bitcoin is recorded on blockchain, not on the wallets. Then what Bitcoin wallet does? So what's the purpose of wallet? You see, Bitcoin is being saved on blockchain. Then why the wallets are there? The wallet stays your private keys and not the Bitcoins. From where you get the private key and whether using the crypto you are getting the private key or not, I will answer it. So whenever wallet is created, two keys are generated, private and public, and they are saved in those wallets. Let me give you an example. If you have an account in wallet and Mr. B wants to pay you in crypto, how will it happen? You will create public key and send it to Mr. B. See, one thing you should not forget, that this is happening on the back end. You're not able to see it. You don't do it. But just to explain you, I have just mentioned this example. So let me read it again. If you have an account in wallet and Mr. B wants to pay you in crypto, how will it happen? You will create public key and send it to Mr. B. He will open your wallet with public key to send crypto, and you can withdraw crypto by using the private key sent by Mr. B. So this is how the transaction takes place. So this is the technical part of it. Now, software wallets, what are these? Bitcoin wallets are apps that can at least create new Bitcoin addresses and store the corresponding private keys. That's the first point of the wallets. Display your addresses to someone who wants to send you a payment. Display how many Bitcoins are there in your address. Make Bitcoin payments. So these are the use of this Bitcoin wallets. So there are various type of crypto wallets. I just want to read the terms of it, just to have a glance of it. Cold wallets, hot wallets, custodian wallets, non-custodian wallets, blockchain specific wallets, multi-chain specific wallets, so etc. etc. There are various type of wallets, which is again a technical part of it. Now, this is a very interesting example of what public and private key looks like and how it works in the case of crypto. What a Bitcoin looks like, see, this is an encrypted one. And so many alphabets and numerics have been used to create it. So this is how the public key and the private key moves and looks like. If you are in the Bitcoin, trading in Bitcoin, or you are creating a Bitcoin, then the public key, private key will be different. If you're trading in NFT, it will be different. So different digital asset with respect to the crypto technology, with respect to the blockchain technology, and different public key and the private keys. What are the most popular crypto exchanges which are running at the moment? There can be various exchanges you may be knowing of, but three, I am just to give an example of it. WazirX is there, CoinDCX is there, and Smith Kuber is there. And interestingly, all of the above are self-regulated because they are having the identity of the user and his details. This line is very important. We must try to understand this line. See, at the moment, the cryptocurrency is not regulated. There is no law. When there is no law, it is called illegal. But there is no penalty for keeping these illegal items with it. So whether it's illegal or not, that's a matter of debate, which is not the topic for the day to me, right? Now, why I'm saying it's self-regulated? Because once you open an account with WazirX, they will conduct your KYC. And when they will conduct your KYC, it's not a KYC on the same lines as the RBI conducts the KYC, but they have used the same term KYC, and they will ask you a few questions with respect to your ID. So once they ask the questions with respect to your ID and you give those answers with respect to your ID, then your ID gets disclosed to the exchange. As your ID gets disclosed to the BSC or NSC through your agent. Here, the concept of agents have not emerged that much, but as the NSC and BSC works, similarly, the WazirX and CoinDCX works. So your identities are with them. Now you just visualize a scenario that government gives a notice to WazirX and asks for the persons who are dealing in the cryptos, whether WazirX will be having that information or not. Whether WazirX will say, whether can WazirX say no to the government that no, sorry, we cannot give you. So just see the repercussions of these exchanges and try to understand as a chartered accountant that what it means when the identity gets disclosed to so-called illegal activities carrying exchanges. Okay. These are a few examples of blockchain and their respective tokens. Bitcoin, the token is BTC. The technology is Ethereum, the token is Ether. The technology is Polygon, the token is Matic. The technology is Solana, the token is SOL. The technology is Axis Infinity and AXX. So these are the various type of tokens which are prevailing in the market which the people are trading in. See, I began my journey with the rider that there may be some lapses, there may be some omissions because it's a complicated field. I have tried to make it easier as far as possible. Two movies I am recommending you. I think most of you must have seen it. One is The Imitation Games. It's a very interesting movie to understand what the algorithm is and why these creation of these algorithms consume so much energy. So, and it's a very interesting movie otherwise also, Imitation Games. And this, and second is, it's on a YouTube, it's a video, why the bubble generates and why the bubble fails, why the bubble happens and why the bubble fails. And this is an example of 1637, almost 400 years. See, I was just when hearing this YouTube video, so one tulip flower was exchanged for purchasing a house. I mean it, what I'm saying. They have shown it in this video, this Netherlands tulip flower bubble. So even one flower can match the value of a house. So you need to understand what the bubble is and why this skyrocketing of the value of cryptocurrencies, where it's leading us to. So these two you can refer to. Now there is a case study which I want to discuss, and I will take not more than 10 minutes of yours, even less than that. How to see, there are two types of investors. One who want to trade through exchanges, and those who want to trade on P2P basis, peer-to-peer basis, right? So if for those who are new investors and they want to enter into the field of crypto, what they have to do? So download any cryptocurrency exchange app, let's say VCM. I am not recommending VCM. Please don't take it in that way. I'm just taking an example. So fulfill the KYC norms. Of course, as I said, these are not the RBI KYC norms, but norms formulated and by the self-regulatory these exchanges. Then this exchange, let's say VCM, they will generate ID and password. You pay money to exchange, let's say rupees 10,000 as you pay to the Paytm. Similarly, you pay to the VCM. An order for Bitcoin, let's say the one Bitcoin costs 1,500, though it's not so, but assuming. So 1,500 is less the cost, then 7,500 gets consumed, you get 5 Bitcoins, and balance of 2,500 remains with the CCE, the cryptocurrency exchange. So this purchase will reflect you in your account, which is managed by the blockchain technology. And that is at the back end. At the back end, this blockchain technology is working. And the balance will appear in account managed by VCM. So this particular account is just on the similar lines than the Demat accounts are. You will come to know how many you are having and how much is the balance. These financial and the inventory, these two parts will appear in the VCM accounts. And for that, they use blockchain technology. Now, you don't need any crypto wallet for it, as I explained in the beginning. At back end, but the crypto wallet will be needed, but you don't need to purchase it. Then who will do it? So at the back end, VCM will maintain your wallet for managing your private key. So because it's not a front-facing wallet, so you're not able to see it, but at your end, at your back end, your private key is being managed by VCM. So for each and every user, they create a private key and public key. So this is how this chain of crypto moves. Now let's go to the new investor who is working on P2P basis and who doesn't want to use it. This was the example where you want to route through exchange. Now let's take an example where you don't want to route through exchange. So new investor without exchange, what will he do? This is basically P2P transaction. You will subscribe your own wallet. That's the first point. From MetaMask, etc. They give you wallets and they charge for it. So they are called service providers of the wallet, right? So payment you will directly make to seller and he will transfer your crypto to your blockchain. So by using the wallet, you will the private key will be generated and you will send it to the other person who is standing on the other side of the globe through this internet. And here you don't need any exchanges. So it was so complex a process and so many people. Do you know how much is the figure of the investment that is there in India with respect to these crypto investments? It's more than 6 lakh crore rupees. How much is 6 lakh crore rupees? Our budget, which was announced just a week back, that is of 39 lakh crore rupees. And the investment in the crypto is 6 lakh crore rupees. And the number which I think is 30 million. 30 million? So 30 million is the 3 million is the number that is there in India. 30 lakh. Those who have invested in the cryptos. So that's why this P2P is now not working that beautifully. That's why the exchanges have emerged. FT and NFT. For FT wallet may or may not be required, as I explained you just now, for trading In a crypto coin, if you go through exchange, you don't need wallet. If you don't go through exchange, you need wallet. But for NFT, the wallet is compulsory. And those who hold the NFT inventory, those who are selling it, they are called NFT platforms. And NFT platforms are different from the crypto exchanges. Now, this is the last part of it. I think perhaps this is the last slide. It's a very interesting question, which is asked at various platforms. Three banks of India, which I know, perhaps maybe the list is more or less. HDFC, SBI, ICICI. They don't allow you to make payment in INR to these crypto exchanges. The very interesting part is your money is lying in State Bank of India, Patel Nagar branch of Delhi. Now you want to use it to purchase crypto. Now can you or can you not? If I want to hear a plain answer, the plain answer is you cannot, because SBI doesn't allow it. Now the cryptic answer, the cryptography answer. Okay, so let's take an example to understand the cryptography answer. What to do? For example, visit WazirX. In WazirX, there you will find an icon which is called Tether. TETHER. I am repeating, TETHER, which is a cryptocurrency itself, and the symbol is USDT. The symbol of the coin of Tether is USDT. Okay, WazirX, Tether, and the symbol is USDT. What we are trying to do is to use our money lying in SBI for purchasing cryptos, right? So Tether is pegged against US dollar. Rest of the cryptocurrencies are not pegged against any fiat currency. This is the only crypto coin which is pegged against US dollar. What it means, what are the repercussions, what are the implications? The implication is that's why this particular crypto is called stable cryptocurrency. It's not volatile. Well, almost not volatile. The volatility depends on the volatility of the USD rate. All right. So you have purchased now Tether. So what will happen? Let's move ahead. So if you have an account in SBI and you want to purchase crypto of, let's say, 10,000, then transfer 10,000 rupees to a UPI, which is allowed. So transfer 10,000 rupees from your SBI to your UPI account. So now your UPI account is having amount of 10,000 balance. Then visit WazirX, purchase foreign exchange of 10,000 rupees by making payment through UPI. So because the foreign exchange sellers are there in the exchanges, so you will get 10,000 worth of dollars by using your UPI balance. But this facility is only for purchasing USDT, not any other. You cannot purchase the currency as such. You will have to purchase on these. That's the WazirX. By using this UPI, you will purchase USDT cryptocurrency. Now you are having a foreign currency with you. So this USDT CC will be used to purchase Bitcoin. So to make the things easier, number one, transfer from SBI to UPI, then use the UPI to purchase the USDT CC, and USDT CC can be exchanged to purchase the Bitcoin. So that's how this world is moving, whether it's legal, whether it is illegal, whether it should be taxed, should not be taxed. That question I am leaving open for discussion. I hope a little bit, I think I was able to communicate a little portion of it. It's a very huge sea of information that is available with respect to the cryptos. So thanks a lot for the patient hearing. And thanks to Ma Saraswati, from here I begin my discussion. And I am so thankful to Arpit Gupta, who is a tech law lawyer, for the technical input. He is basically working with the tech law field. And I am thankful to my associate Vivek for the support. Yes, Mr. Nindara.
Thank you so much, sir. Can you hear me?
Sure.
Sir, thank you so much for this wonderful knowledge relating to the cryptocurrency, because everyone is very, very enthusiastic these days regarding this cryptocurrency, how to buy it, how to value it, and now taxability part is also there. So you have covered so many things in your sir deliberation. So one again question which is given by the members: how to value the cryptocurrency?
I think the valuation answer Komal can give better because she is the valuation expert. Komal, you just unmute yourself.
So they are saying how to value the cryptocurrency.
See, I think Anilji, the answer is very much there in the question itself. How you value Reliance share? Can you tell me
Yes.
what will the value of the Reliance share tomorrow? No one can. So similarly, as I said, it operates on the same manner as the shares and the oil operates.
Yes,
And it depends
yes.
on demand and supply. Basically, the prices are going down. There are various reasons for it. The main 2-3 reasons are China has banned it. In India, there is no clarity about it. Taxation has started. So whenever there are confusion in the investment market, the prices go down. Prices bound to go down. The moment the clarity will come, I'm sure the prices will take their own way.
Another very good question, sir. What is the future of cryptocurrency in India?
I think I answered it. I said
Yes.
the investment is of 6 lakh crore rupees.
Yes.
So
Again,
I
we
don't
need
want to
another
give a
question.
direct answer, but I have given 3 clues to this answer.
Yes,
First
yes,
is
yes.
6 lakh rupees. The second is 30 lakh people are using it. The data which is available on the internet, I'm sure.
Yes, sir. Yes, sir. Yes.
And the third is, which I explained, that how the SBI is saying that they will not allow, and by the route of UPI, the stock exchanges dealing with the crypto, they are allowing it.
Yes.
So whether what's the future? The clue is there. Answer.
Clue is already there. So can we similar question regarding to the UPI? Can we purchase in wallets which belongs to foreign broker? Does FEMA applies to it?
See, the FEMA norms are absolutely applicable to it, and when the initial stage was there, I'm talking about 4 or 5 years back. I was sitting with a very young boy. He was 23, 24. So he was dealing in crypto. I asked him. So to deal in the foreign exchange, he became citizen of Nigeria, and he was using that route to purchase the crypto. And because at that time it was not that much available in the Indian land. So FEMA is very much applicable.
So as an auditor, what are the audit trials which you need to look at while clients have cryptos and how to check valuation part of it? Again, वही.
सर एक बार ना किताब पे ले आइए इसको, फिर बताएंगे उसका ऑडिट कैसे होगा.
ठीक. Again, next question is relating to the value. How did the cryptocurrency get its value in the initial phase?
I explained, as I said, this forum of people, which I just referred to and explained it. This is not a single person, Nakamoto. It's a forum.
Yes.
That's what coming in the various papers.
Yes.
So when they created this crypto, it was very small in number. One slide, I think it has got missed. There is a technology which is called ASCI, or perhaps I am forgetting the name of that technology. So that technology is used for minting the cryptos. And for minting cryptos, you use very sophisticated and very costly hardware and costly software, and algorithms have to be solved. That's why I recommended this movie, Imitation Game, because in that they have explained in a very entertaining manner. They have explained what algorithm is. So when the algorithms are solved, so it's not easy to solve the algorithms. So it's not easy to increase the population of the cryptos. So once it cannot increase, so there is a shortage of demand, and there is shortage of supply. Demand is there, the prices are skyrocketing.
Sir, one last question that is related to.
Sure.
Just a moment, sir.
No.
Yes, sir. This is relating to the GST part. Just like the FEMA, he's asking whether GST required to be paid on commission paid for cryptocurrency.
सर मत बोलो, इनकम टैक्स लग गया, जीएसटी और लग जाएगा,
और लग जाएगा. Exactly, वही कह रहा हूँ, वो लग जाएगा. वो यहाँ कह रहा हूँ. तो
इसका next question आएगा for the it will be for Komal, whether India will be applicable or not.
Yes, sir. last question,
Kamal,
sir.
Kamal, what
मैडम
is
से related ही है recognize करने के लिए.
Let
What
me
is the
hear
use
Kamal.
of?
Kamal, can you hear me?
Yes,
What you
sir.
have to say whether India's is applicable or not?
बिल्कुल सर, applicable.
वो कह रहे हैं कि what is the use case of using a cryptocurrency when the government does not recognize? What is the use case of using a cryptocurrency when the government does not recognize?
Please try to understand one thing. The commerce and economy, they move on the basis of demand unless it is hindering the national interest.
Yes, sir.
There were two cases where there was voice against the crypto. See, for the extortion purposes, cryptos were used. For transferring the terrorist money, the cryptos were being used. So that was the bad part of it. So with these exchanges, as I said, they are self-regulating themselves because they are expecting that any day they will start acting as BSC and NSC Act. As there is SEBI, there either it will come under SEBI or maybe I don't know what law will be formulated in the coming years. So in my opinion, whatever I have read till date, I am not sure about my opinion, but this is going to be part of the economy.
Thank you, sir. Thank you so much, sir. Hope we will be requiring more and more, or two or three more sessions on this cryptocurrency, its flexibility, its future, its valuation. So I hope there are 2 or 3 more sessions are required. So again, we will request you for the next session, sir, on this cryptocurrency for enlightening our members. So for this, for today, these were the questions. And thank you so much for sharing your valuable time, sir. And for your words of wisdom, kind words of wisdom relating to this cryptocurrency and its part and its future by giving your expert opinion, sir. Thank you so much, sir. Thank you so much.
Thank you. Thanks.
Once again, thank you so much, Komalji. Thank you so much, Arvind, sir.
Thank you, sir. Thank you.
Thank you, Kamal.
Thank you, sir.
Thank you. Good evening.